This is Rebecca with the Cat and Rebecca Show, Keep It Real Estate, and we're with Kavanagh from the Franklin Loan Center, and we are going to talk about mortgage insurance. So first of all, what is mortgage insurance?
Mortgage insurance. Mortgage insurance is an insurance policy that we, the lender or the investor, take on you, the borrower, when you don't put down a sufficient amount of money for a down payment.
Kind of the risk you have for taking a loan for not having enough equity in.
That is correct. And it's not on every loan. It changes from loan to loan and person to circumstances.
Okay, so then why is it specifically different? Is it?
Well, different types of loan require different types of mortgage insurance. FHA loans, okay, they have something called MIP, Mortgage Insurance Premium. They have a set insurance that's there. It comes in two different forms for the loan. It comes in an upfront mortgage insurance, which is 1.75% of the loan amount. It also comes in a yearly, which is broken down into a monthly payment. That is the same no matter who you are, what your credit scores are like, and what kind of home you're buying. Okay? Based off of either you put 3.5% down or 5% or more down, it's two different rates.
Okay.
Either 0.85% or 0.80%, period. No matter what kind of home, no matter what your credit is like, as long as you have an FHA loan.
Well, my next question was because you were talking about the down payment. The big question I get all the time is how much do I need down not to pay mortgage insurance, because that's one less payment you have.
Okay. So on that regard, we talked about mortgage insurance premium for FHA loans. Then you have mortgage insurance for conventional loans. This is going to be a little bit more different.
Okay.
Mortgage insurance for conventional loans is called PMI, private mortgage insurance. They are not any in particular insurance by the government. These are private companies that work like banks. And every one of those private companies has a slightly different mortgage insurance rate, depending on what your credit score is, the type of property that you're buying, how much down that you're putting down, anywhere from 3% down to 20% down. And they're all slightly different, and you can shop the rates a little bit. Most of them are very competitive, okay? When you have a conventional loan and you put 20% down or more, you will not have mortgage insurance.
Okay.
Okay.
And what's the...
On an FHA loan, if you put 20% down, you still have mortgage insurance. You will always have mortgage insurance on an FHA loan. It's the way that the FHA insures the loan and stays in business. There is an exception to that rule. Mortgage insurance for an FHA loan, if you put 10% down or more, will go away after 10 years. All by itself. You don't have to refinance the loan. You don't have to alert your servicer. It will be gone after 10 years, providing you put 10% or more down when you do the loan originally. Mortgage insurance premiums or private mortgage insurance for conventional loans, they will be in place for 2 to 5 years minimum, depending on the mortgage insurance company. And after those 2 or 5 years, depending on what it is, you can petition that mortgage insurance company to go ahead and drop the mortgage insurance, either with a new appraisal on the house to show that you've got sufficient equity, that you've got your 20% equity, or possibly something called an automated value system to show that it's there. Or they also have it in there once you reach a certain payment that you've made, number 96 or 120, it will automatically be removed as well.
Okay, so this is insurance on the mortgage to mitigate the risk of the lender should a buyer or a homeowner fail. And this is not to be confused with homeowner's insurance, which is for the risk of the home should there be a fire.
That is correct. Two separate things. In reality, you don't really want mortgage insurance because that is not benefiting you, the borrower, at all. It's only benefiting the lender, us, or the investor. What we use that for is if you fail to make your mortgage payment, we will go ahead and after so many months, be very polite, and then we'll kick you out of the house.
Yes.
And then we'll use that mortgage insurance premium to go ahead and pay the interest that's due on these until we can go ahead and get the house sold in a real estate market.
Yeah, I think there's always a confusion. So the insurance is usually to mitigate someone's risk, in this case, the lender's risk.
The lender's risk.
And when you get homeowner's insurance, it's your risk should something happen to the home.
There's one other way that you can get rid of mortgage insurance if you don't want to wait for your 10 years, your 2 to 5 years, provided that you do have the sufficient equity in the house. You can always just refinance the house. Most people do that because they don't want to wait 5 years. And with the lower rates, as long as it makes sense to them, they can refinance the house and not have to wait. And providing you have the equity, it'll just wipe away the mortgage insurance. But you'll have whatever the prevailing rates are for that day.
Okay, well, that's given us a lot of information. I guess the next part would be to meet with an appraiser to know what the difference is on appraising for that refi or appraising for purchase. So stay tuned. This is Rebecca and Brian at the Kat and Rebecca Show. Keep it real estate.